Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi, everyone, and welcome to another episode of the Physician's Guide to Financial Wellness. This is Trent DeBruin, and I'm joined, as always, by my co-host, Andrew Mushbaugh. And today we're going to talk about a common retirement planning topic, which is long-term care. And we know that, similar to life and disability insurance, this isn't necessarily the most fun topic to discuss, but it is an important one given how common long-term care events are and also the potentially large cost of them and how that can impact your financial plan. So what we're going to do today is start out by providing some background and overview of long-term care and some of the numbers around frequency and cost. Based on that, we'll explain why it's important to have a plan for how to protect against long-term care risks. And we'll then wrap up by talking about some of the different options for how to actually protect against this risk, which at a basic level is either buying insurance, self-insuring, or some combination of the two, and discuss some of the pros and cons of each option. So our goal for you is to come away with a good understanding of this planning area and which approach is right for you based on the specifics of your unique situation. And before we get started, Andrew, I'm pretty sure we've talked about this, but just to confirm, your long-term care plan is having Grant take care of you when you're old and feeble, right?
Yeah, that's the current plan, but I'm always open to a team approach as our family grows.
I like that team approach idea. I guess I'm lucky that I already have 4 options.
I think we all know that Bennett may be the clear frontrunner there.
Yeah, well, he is 8 years old going on 45, so hard to argue there. But why don't you get the discussion started by providing a little bit of background on long-term care?
Sure. So as most of you probably know, long-term care services involve someone helping you with the basic activities of living if you're unable to do them on your own because of illness or old age. These include things like eating, bathing, dressing, moving around, etc. Long-term care services can be provided either at home or in a long-term care facility, or as Trent revealed with my plan, your kids and or family. And depending on your age, health, and family history, needing long-term care may or may not be something you can envision, or it may be something that feels like an inevitability. But regardless of what you can envision, it's an extremely common occurrence as people age. Just to put some numbers to it, approximately 70% of people turning age 65 today will need some form of long-term care services during their lifetime, and 20% of those people will need care for 2 years or more. The average duration of care for women is 4 years, and for men it's 2 years. So most of us will need some type of long-term care during our life, which, as we'll discuss, means this is an important area to plan around from a financial perspective. So roughly 70% of people turning age 65 will need some form of long-term care services, but for the majority of people, there will be zero or minimal cost. However, for a minority of those people, they will experience a prolonged long-term care event where the costs can really add up. In other words, when planning around long-term care expenses, the concern isn't around needing long-term care services at some point in the future, it's about needing those services for a prolonged period. And one thing worth mentioning here, which you may or may not know, is that health insurance doesn't cover long-term care costs. Medicare can cover short nursing care home stays or limited amounts of home health care, but it doesn't cover most long-term care services. And although Medicaid does cover long-term care, you have to show extremely low income and assets to qualify for Medicaid. So this isn't relevant for most people. And therefore, long-term care is something you have to handle yourself, whether that's by purchasing long-term care insurance or self-insuring. Going back to some additional statistics, of the people turning age 65 today, approximately 65% of them will have zero out-of-pocket long-term care expenses during their lifetime. However, approximately 20% of them will have total lifetime long-term care expenses between $50,000 and $250,000, and 10% of them will have lifetime costs of more than $250,000. So you can see why a long-term care event can be such a major expense and how it can negatively impact a retirement plan. And even though not everyone will experience a big long-term care event, in fact, most people won't, everyone needs to at least have a plan for how to protect against a long-term care event in case they are unlucky in that minority. In many ways, it's similar to other risk events like death or disability. Most people won't experience a disability or premature death, but if it does happen, that would have a huge financial impact on you or your loved ones. So even though you're not expecting it to happen, you need to have a plan for how to handle it if it does. So it's easy to understand why having a long-term care plan is important, but the question then becomes, how do you go about figuring out that plan and choosing the right approach for you?
Yeah, as I mentioned, at a basic level, there are essentially 3 different options for how to protect against the long-term care risk. Number 1, you can self-fund, which means covering the costs yourself out of your savings and investments. 2, you can buy long-term care insurance, which we'll talk about a bit later. And 3, you can do some combination of the two where you self-fund a portion of it and buy some insurance to supplement. So the first step in putting together your plan is figuring out whether or not you can self-fund. In other words, can you afford to pay for a potential long-term care stay from the assets you've accumulated for retirement without it impacting your retirement plan. And unfortunately, there isn't a clean black and white formula for determining whether you can self-fund, but we'll walk you through a process to follow to figure it out. Step 1 is determining the probability and timing for potentially needing long-term care. This is going to be different for everyone because different people have different likelihood of needing long-term care. As Andrew alluded to, women live longer than men, which makes a long-term care stay more likely, and women also have a longer average stay. Family health history is also a big factor, as is age, i.e., the odds of needing a long-term care stay increase as you get older. So as you can see, this is a very individualized situation that will vary significantly from person to person, and it isn't a scientific process, but as a starting point, you want to think about your situation and come up with a rough estimate of the potential likelihood and duration of a long-term care event. Step 2 is then understanding the cost of a long-term care event. We sometimes talk about long-term care as a fixed service, but there are different types and the cost varies materially depending on which option you choose. For example, in-home care, assisted living, nursing home, etc. Cost also varies a lot depending on your geographic location. There are different online calculators that can help you calculate the cost in your area, and we'll link to one in the show notes, but just to give you a sense of what things look like in our local area, for Ann Arbor in 2021, the median monthly cost for a home health aide or an assisted living facility was around $6,000. The monthly cost for a semi-private room in a nursing home facility was a little under $10,000, and the cost for a private room in a nursing home facility was a bit over $11,000. So you're looking at an annual cost of anywhere from $75,000 to $135,000, depending on the option, which you can see why the numbers can get really big for an extended multi-year long-term care stay. So after estimating the likelihood and duration of a long-term care stay, step 1, and understanding the cost of different long-term care options in your area, step 2, you can then move on to step 3, which is estimating the cost of a long-term care stay for you based on your situation. For example, you might prefer in-home care to a private nursing home, which is much cheaper and would reduce your potential costs. Also, I know we joked about Andrew's son being his long-term care plan, but joking aside, there are situations where people have friends or family, most often children, who would be willing and able to provide long-term care if needed. So in those situations where you do have free long-term care available, your estimated cost would potentially be zero. But whatever your situation and preferences, step 3 is about realistically estimating what your personal long-term care expenses would be. And if it's you and a spouse, what your household's expected costs would be. That allows you to move on to step 4. Step 4 is when you take that estimate for what your household's long-term care expenses could or would be and plug them into your retirement projections to see whether your current retirement plan can absorb a long-term care event. There are different ways to do this, but we use financial planning software that runs a detailed Monte Carlo analysis looking at 1,000 different scenarios and calculating a probability of success for the retirement plan based on all those potential scenarios. So if you do have access to financial planning software, you can add your estimated long-term care costs as another item or goal in the projections and see how it impacts the projections and whether your probability of success remains above your target level. However, we know not everyone has this type of software available to them, but even if you don't, you can still run your own version of this analysis using Excel or an online retirement calculator to give you a ballpark idea of how things look. If you run the analysis and find that your plan and projections are still in good shape, assuming a base case for expected long-term care costs, you'll know that under that scenario, you have the ability to self-fund long-term care costs through existing or planned savings and assets, and you don't have a need to buy long-term care insurance. So that's good information to have, but the final step is looking at a more dramatic scenario and confirming whether you would still be in good shape there. So for step 5, you want to consider a theoretical worst-case scenario for your household. Nobody has a crystal ball in terms of what the future will look like, and while it's helpful to consider the base case and what that looks like, it's also worth considering a more dramatic scenario to stress test your retirement plan. So going back to what I shared in steps 1 through 3, and using the long-term care calculators, you'd want to figure out how large your long-term care costs could potentially be under this worst-case scenario. You'll then want to plug this new, higher number into your retirement projections to see what the impact would be. Maybe you find that even under this worst-case scenario, your plan and projections are still in good shape, and you'd be able to self-fund even significant long-term care costs. If so, that's great, and you know that you don't have the need for insurance. On this note, one thing to mention for people who do plan to self-fund, especially people who have a bucketing mentality when it comes to finances and like to have certain accounts earmarked for certain purposes. For these people, it can sometimes be helpful to create or earmark a specific investment account for potential long-term care expenses. If at some point you do experience a long-term care event, you have a pot of money readily available and accounted for to pay for those costs. And if you don't, then that money is available for other uses, such as passing on to heirs or something else. However, perhaps under either the base case and or worst case scenario, you find that your retirement plan would be dramatically impacted by a long-term care event, and you would have an elevated risk of either running out of money in retirement or at the very least having to make significant cuts to your spending and lifestyle. If that's the situation and you know you aren't able to self-fund your long-term care risk, you'll have to consider your other options. Perhaps you decide you're comfortable with that risk, even though you know that if it did materialize, it could have a significant impact on your plan and lifestyle. Different people have different levels of risk tolerance, and some are more comfortable than others taking on risk, so you may be comfortable with it. However, if you aren't able to self-insure and you aren't comfortable with that risk, you'll need to see what approaches are available to you and come up with a plan. Maybe you could downsize your home if needed or cut out certain costs in retirement. Alternatively, maybe if you haven't retired yet and are still working, you could decide to work a couple years longer to strengthen your retirement plan and add more cushion to your projections so they can absorb a potential long-term care event. Or perhaps, as mentioned, you have children or other people who would be willing to step in and help if truly needed, although obviously this may not be the ideal scenario for everyone. However, you may be in a situation where none of these are options for you, and you have to consider insurance as a way to protect against long-term care risk. So if you can't self-insure and you aren't comfortable bearing the long-term care risk, insurance might be a good alternative.
Yeah, insurance is always an option when it comes to guarding against long-term care risks, although there are definitely some pros and cons and some pitfalls to avoid. One thing to note right off the bat is that unfortunately, there's no perfect age for buying long-term care insurance in terms of getting a quote-unquote good deal on it. Long-term care insurance is similar to life insurance, where you get a better price if you buy it when you're younger and healthier, but that also means you then have insurance and are potentially paying premiums for longer. Having said that, we know most people like rules of thumb or just a ballpark age of when they should consider purchasing long-term care insurance. So at least in general, if you're a couple shopping for long-term care insurance, you may want to consider looking for it between age 55 and 60 for the best combination of coverage and affordability. On average, people who buy long-term care insurance tend to buy it sometime in their late 50s. When it comes to long-term care insurance, there are two basic types. There's a traditional standalone policy, and there's something called a hybrid policy, which I'll walk through each type. A traditional standalone policy is similar to car insurance, where you pay a monthly premium for a certain amount of coverage, and that premium is subject to increase over time. Like car insurance, it's a situation where you ideally don't want to have to file a claim and actually use the insurance. So in that sense, it's a quote-unquote use it or lose it insurance, but it's there for you if needed as long as you continue to pay the premiums. To give you a sense of the dollar amounts involved, for a 55-year-old man, buying a policy that would cover $165,000 of long-term benefits, he would expect to pay around $2,200 per year on average for that coverage. Given the higher likelihood of needing long-term care, a woman the same age would expect to pay around $3,700 per year for that same amount of coverage. It's worth noting that these numbers assume the policy has an inflation rider, where the value of the benefits increase over time with inflation, which is important if you're going to have this coverage for multiple decades. This is just an average based on a basic policy and survey of insurers from the American Association for Long-Term Care Insurance, and premiums can vary widely depending on your age, health, and the specific details of your policy, but that gives a ballpark idea. So that's an overview of a traditional long-term care policy, but another option you can consider is what's called a hybrid policy. A hybrid policy is different than a traditional standalone policy because it combines long-term care benefits with a life insurance policy. It's essentially a type of whole life insurance policy with long-term care benefits added onto it as well. And one of the biggest differences between a hybrid policy and a traditional policy is the way you pay for a hybrid policy. Instead of recurring annual payments, you typically fund or pay for a hybrid policy through a single lump sum payment on the front end, or payments over a set schedule like 5 or 10 years. For example, you may purchase a hybrid policy with a $100,000 lump sum payment in return for long-term care benefits of $500,000 and a life insurance death benefit of up to $200,000 in the event that you die before using any of the long-term care benefits. For the majority of people, you end up having to tap into the policy, or at least utilize some of the long-term care coverage, which reduces the value of your death benefit, potentially down to zero. Another thing worth noting is that depending on the insurance company or the policy, some or all of the $100,000 upfront premium can be returned to you if you change your mind down the road and decide you no longer need the coverage. This is called return of premium, and the amount and details depend on the insurance company, so it's important to understand the details of your unique policy. At this point, if you're like most people, the natural question would be, why would I want a traditional standalone policy that can be a use it or lose it type situation when options like a hybrid policy exist? However, like most things, there is no free lunch, and there are always trade-offs involved that you'll want to be aware of when determining the best route for your situation. While these hybrid policies may appear to have no cost and offer the best of both worlds, there is a cost associated with these policies. It's just baked into the economics of the policy. The insurance agents who sell these receive a nice commission on the front end, often 5% or more of the premium amount, and the insurance company needs to recoup this commission, plus make a profit on the policy. So the amount of insurance coverage you receive is reduced to incorporate this.
Yeah, so as you can tell from that overview, each type of long-term care insurance has its own unique features, and what's right for one person might not be right for another. So I'll now walk you through some of the pros and cons of each to help you understand which, if either, might be right for you. And starting with the traditional policy, some of the biggest benefits include less upfront money required to purchase the policy, since you pay monthly premiums rather than a larger lump sum, and better ability to customize the policy to fit your specific needs and situation, i.e. being able to choose the amount of coverage you need and the riders for your policy, which are essentially features and add-ons to your policy. What this results in is a more simple and straightforward long-term care policy, since you're buying exactly what you need and paying for it for as long as you need it. In some ways, it's similar to life insurance, where a traditional long-term care policy is like a term life insurance policy, whereas a hybrid long-term care policy, as Andrew explained, is more like a whole life insurance policy, where it's insurance coverage plus something else. So a traditional policy is the more efficient type of coverage. That being said, the biggest drawback for a traditional policy is that the cost of premiums isn't guaranteed and can increase over time. In fact, in recent years, you've seen this play out where certain insurance companies have increased the cost of premiums by 50 to 75% or more in a single year. And the reason why this has happened is that many insurance companies dramatically underestimated the likelihood and cost of long-term care, and therefore the benefits they'd have to pay out to the people who bought the insurance policies when they sold these policies many years ago, and have since had to increase the cost of premiums to avoid losing money. It's possible that newer policies won't have the same issue and will be better priced with smaller future cost increases, but unfortunately this is a big risk and unknown with traditional policies. In addition to the lack of visibility regarding the future cost of insurance, some other drawbacks of traditional policies include, as mentioned, the fact that your ideal scenario for a traditional policy is to pay the premiums and not have to use it, therefore not getting quote-unquote anything in return, and also the fact that you have to submit receipts for reimbursement and you have to receive your long-term care from a licensed medical worker, so it can't be provided by a family member or a friend. Switching gears to hybrid policies, one of the key positives for them is that since you're paying the premium as a lump sum all at once, rather than paying ongoing monthly premiums like you do for a traditional policy, your cost is guaranteed and you don't have the risk of premiums increasing over time like you do with a traditional policy. Another benefit is that there's flexibility with the amount of coverage you purchase. So maybe you think you might want $200,000 of long-term care coverage. Well, instead of buying one $200,000 policy, you could buy four $50,000 policies. Then if over time you decide you don't need all that coverage, you have the ability to drop one or more of the policies, assuming you have the return of premium feature, and keep the others. Other benefits include flexibility with who provides your care. You can pay a friend or a family member rather than a licensed medical worker, and easier qualification. Many people who apply for long-term care insurance are declined for one reason or another, often due to current health or a pre-existing condition with a disease that makes them quote-unquote uninsurable. In fact, on average, more than 20% of people in their 50s who apply for coverage are denied, and more than 30% of people who apply in their late 60s are denied. So this can be relevant. So those are some of the main benefits, but there are also some drawbacks. And one of the biggest ones is simply that a hybrid policy is more expensive for the same amount of insurance coverage. The reason why is the same reason why whole life insurance is more expensive for the same amount of insurance coverage compared to term life insurance. You're combining two products into one, which makes it less cost efficient. With life insurance, you're almost always better off buying the insurance coverage you need through term insurance than investing the remaining money you save in premiums compared to buying whole life insurance, as opposed to buying whole life insurance where you're paying for insurance plus a savings and investment component. Similarly, with long-term care insurance, from a pure cost standpoint, you'd be better off buying the long-term care coverage you need through a traditional policy and the life insurance coverage you need, if any, through a life insurance policy. Another drawback of hybrid policies is that they aren't as customizable as traditional policies. With traditional policies, you're able to choose which riders you want, like inflation protection, your elimination period, or how many days before the policy starts paying out benefits, etc. However, you aren't able to customize hybrid policies as well. An additional downside is the upfront cost. As mentioned, buying a hybrid policy can involve paying an upfront lump sum premium of $100,000 or $200,000 or more. Not everyone has that much cash readily available, and if they do, a better approach for long-term care might be to simply invest that money and earmark the account for long-term care. Lastly, as you've probably gathered, hybrid policies, similar to whole life insurance policies, can be confusing and difficult to understand. So that's a brief comparison of the two main types of long-term care insurance. And as you can tell, each has its benefits and drawbacks, and if you are someone who wants or needs to buy long-term care insurance, it's about looking at your own situation relative to the pros and cons of each and deciding which type of policy is right for you.
I know we went through a lot there, but hopefully that helped to provide an overview of long-term care so you can understand the situation and how to view it within the context of your own retirement plan. Our key message is that when it comes to long-term care, not everyone needs insurance, but everyone should have a plan so that in the event a long-term care risk materializes, its impact is manageable. The exact nature of that plan is going to be different for everyone based on their unique situation. For some people, it's going to be self-funding, while for others, it's going to involve buying long-term care insurance. Also, we want to point out that your plan doesn't need to be an either-or situation. Even for people who are planning to self-fund, there's still risk involved. For example, if future long-term care costs end up increasing more than expected, or if there's bad timing with the economy and investment returns when you need access to the money earmarked for long-term care. So a third option is always a blend of the two, where you plan to self-fund a portion while also supplementing it with some insurance to provide peace of mind and protect against those risks that still exist with self-funding. As with most things that we discuss with personal finances, there's not necessarily one black and white right or wrong answer, but it's about finding the plan that works best for you.
Yeah, and just to give a quick recap of some of the key points. Number one, most of us are likely to experience some type of long-term care event during our lifetimes, which isn't covered by insurance. And while for most people the cost is likely to be small, for a minority of people the cost can be quite large to the extent that it could potentially impact your retirement plan. Number two, because of this, everyone should have a plan for long-term care, whether that's self-funding, buying insurance, or some combination of the two. Number three, step one is determining whether you can self-fund, which involves covering the costs through current or planned savings and investments. You can use the process we shared to determine whether or not you can self-fund. Number four, if you realize you can't self-fund, or if you have the ability to self-fund but still don't feel fully comfortable doing so, you'll want to consider insurance. The two general types of long-term care insurance are traditional and hybrid policies, and each has its own pros and cons, so you want to reflect on those and see which is right for you. And lastly, number five, there's no right or wrong answer in terms of your long-term care plan, whether that's self-funding, insurance, a combination of the two, or having your children pay you back for your years of loyal service to them. It's about finding the plan that's right for you and works best for your situation. Well, thank you as always to everyone for joining us for another episode of the show. You can find the show notes at the podcast page of our website, mdwmllc.com/podcast. And you can email us at info@mdwmllc.com with any thoughts or questions. Take care, everyone, and we'll look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight from Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.